Okay, here we go. All right, great. Good to hear. Good stuff in the chat there. Good to see everyone. All right, let's restart here. Had a little issue with the sound, but I think we're good to go now. So, um, last month we did a YouTube session. This topic is going to be very similar, but we'll have some of the similar information from last time. But I think this time we'll expand on it a little bit further. We'll also dive into overall price action, supply, demand, and all that. Again, great to see everybody. Let's move forward. Now, if anyone, well, anyway, we'll get to that later. We'll get to that later. All right. So make sure you understand we are not investment advisors. Um, and certainly trading does not come with a guarantee of success. In fact, available research suggests that, like I said a minute ago, uh, most day traders or active traders are not profitable. They lose money. And that is the topic of basically today. Okay. So make sure you understand the risk. Make sure you take your time and understand what you're getting involved in. Again, getting involved in something that most people are not successful with, you have to be very careful because we're putting your hard earned money on the line here. So I want to make sure that this is, we cover as much of this topic as we can. Um, we can talk all day about how to make money in the markets and all that, but it's almost more important that we focus on this concept of losing because a lot of people lose money. Okay, let's dive in. So we're going to talk about a little bit different than last time. We're going to start out talking about how and why prices move in markets. What causes prices to turn? What causes prices to move in markets? How markets really work. We'll certainly spend most of our time on the fact that most traders lose money. We'll dive into why that might be. Some topics there. And then we'll cover some strategies that may be faulty when we run them through the filter of how you make money buying and selling anything in life. Okay. And I'll try to go through this fairly quickly. If you have any questions, you can always put them in the chat. And so let's begin. When it comes to now, we're talking about the financial markets, trading markets today, and everything we're going to talk about applies equally to all asset classes: stocks, futures, forex, options, crypto, bonds, real estate, you name it. But we could talk about any market, the market for cars, houses, food, appliances, clothes. It doesn't matter, right? If it's a market with something being bought or sold and price, the movement of price is a function of an ongoing supply and demand relationship. Now, at this point, I know most people focus on supply and demand. Prices turn higher at demand, turn lower at supply, and uh, but a lot of people don't focus on the middle, which is fair value. Okay, let's start with that because when we do our analysis to figure out where prices are most likely to turn and where they're likely to move to, that's where we start. That's what we focused on in the beginning to start. Fair value. What is fair value? Fair value is where the majority of buyers and sellers agree to buy and sell in a market. And again, this could go for any market. Think of when you buy food at the market. Maybe it's ice cream. Maybe the ice cream costs you, I don't know, $4 for the container of ice cream, your favorite ice cream. Well, I'm sure everyone would love to buy that same container of ice cream at a dollar for a dollar, but the store wouldn't make enough money, and we wouldn't have a store to buy ice cream at, right? So that's not possible. The store, on the other hand, would love to sell the ice cream at $10 a container, but most people wouldn't buy it. They would choose something else. So again, the store would not make any money there, and um, it just wouldn't work, right? So, like any market, we all agree to buy or pay a price that's somewhere in the middle. Does that make sense? Not everybody, but the majority of buyers and sellers. And the same holds true for any financial market out there as well. Fair value, because it's where the majority agree to buy and sell, naturally pulls price back to it. With supply, demand, and fair value, there's always this governing dynamic at work of push and pull, right? Fair value, again, which is where the majority agree to buy and sell, naturally pulls price back to it. Sometimes price moves higher, right? Based on a lot of buyers coming into the market, pushes price higher to price levels where supply greatly exceeds demand. That competition to sell at supply naturally pushes price back down. Just like sometimes, like this week, today in the equity index markets, for example, right? We'll look at some of those markets soon. A lot of selling is coming into the market, a lot of supply that pushes price lower, right? And price eventually reaches a level where demand exceeds supply. That competition to buy at demand naturally pushes price higher, right? So supply and demand are pushing price back to the middle. Fair value, again, which is where the majority agree to buy and sell, naturally pulls price back to it. And that's how prices turn and move in any and all markets, right? Now, the important question for the screen-based trader is, what does that picture look like on a price chart? Let's start with the middle. Fair value has two characteristics. And by the way, we um, we always start with identifying fair value. We don't start by looking at a chart and saying, where's supply, where's demand? We start with fair value for a couple reasons. The big one is it's just it's well, we want to identify fair value because we don't want to enter trading positions inside fair value, and it's also not that difficult to see on a price chart. Fair value has two characteristics when we to identify. Number one, where's the majority of trading activity? Okay, clearly this is a lot of trading activity. And two, where is that wide and whippy trading activity? Right? Okay, so those are the two characteristics we'll look for to identify fair value. Then we want to look above fair value for our qualified supply zone and below fair value for our qualified demand zone. Does that make sense? Diego, great question in the chat there. Which asset class is better to trade? I wouldn't say one is better than the other. It's all a matter of it's an individual thing, right? So the questions that will likely lead to the answer for you or anyone in specifically is, what are you trying to achieve? You know what I mean? What's your ultimate goal? And and then how much capital do you have to put towards this, to risk at this with this, um, and how much time do you have to put towards this? All those things. Okay, but it's not necessarily that there's one market is better than the other. They all have pros and cons, and but it's about matching up that right asset class with your individual needs. Okay. Fair value does not always look different. In fact, it usually looks the same. Okay. Now, so this is what it looks like on a price chart. But I want to, the most important thing here is um, we don't want to enter positions inside fair value. Why? Why don't we want to enter positions inside fair value? Okay. And then Diego, I'll get back to you in a second on that last comment. We don't want to enter a position in fair value because of this, right? Ultimately, the lowest risk, highest reward, and highest probability entry into any trade or investment happens as close to the turn in price as possible, right? But think about it. So identifying where the highest probability turning point is in a market means identifying where the largest supply and demand imbalance is in a market. The largest supply demand imbalance is where price is most likely to turn. That's what's missing in the middle. The reason why price has such an easy time moving up and down like this is because there's a lack of a significant supply demand imbalance. The vast majority of what looks like a supply demand zone in the middle here is going to fail. All your rally-based rallies and drop-based drops that are inside fair value, I mean, don't quote me on this number, but probably 90% of them are not going to work when price comes back, right? It's not that they didn't have a supply demand imbalance when they were created. They did, but not a large enough one to cause price to turn again. Does that make sense? Okay. So we don't want to enter positions in the middle, especially in the middle of fair value. You can see here, drop base drop, price goes through it. Rally base rally, price goes right through it. And on and on and on. Rally base rally, price goes right through it. Okay. If you're, attempting to, now I know there's a lot of different versions of supply demand out there these days. When I designed the strategy many years ago, that was the original supply demand strategy. That's still what we use today. But I know over the years now, people have taken it and put all these indicators to it and oscillators and this and that. And I understand there's confusion out there, but this concept, if we were in an economics 101 class, we'd be having the same kind of conversation, right? So that's the main reason we don't want to enter positions in the middle, because trying to predict where price is going to turn and managing the risk against that is extremely difficult in the middle. You don't have a big supply demand imbalance. Outside of fair value we do, but not inside. We want to stay away from the middle. Real quick, back to Diego up there. You said, I found Forex a little bit stressing. Yes. So again, if we're being very, very real, um, one of the most challenging ways to make money in the whole trading world, from at least from feedback that I see and experience and all that, is short-term day trading the spot Forex market. There's some clear reasons for that, like the spread that you have to overcome, and how how orders are matched up and who they're matched up against, right? So you know that's important. Okay, now, so how do we? So if this is how markets work, how do we map it all out? Again, if we keep it to real supply and demand strategy, the original supply demand strategy, it all comes down to two things, not like 15 things or 10 things or 20 steps or this or that. It's all structure and location, right? When I say a qualified supplier demand zone outside of fair value, talking about structure, there are four things that have to be present when it comes to structure. You can't have two, you can't have three, you have to have four, right? And then once we have a qualified supply demand zone, where is it located? Is it inside fair value or outside fair value? Make sense? So let's look at some recent opportunities. These are all screenshots, I believe, from this week, this week or last week, from our live trading and analysis sessions. And you can see here the so let's take a look at the setup over here. We're going over this one with our members here, right? So this is the NASDAQ was trading up into our qualified supply zone here, right? But notice at the time price was up here, we certainly had a little pocket of fair value here, but the big one was right down here, okay? And then, I'm not sure exactly where the NASDAQ is at the moment, but it's probably down. Well, it's down in here, right? This is um, yeah, down in here. Okay, makes sense. So competition to sell its supply. Notice the rally base drop with a gap. Competition to sell its supply pushes price lower. Fair value, which is where the majority agree to buy and sell, pulls price back to it. Don't forget the two characteristics of fair value. Where's that recent and relevant majority of trading activity and that wide and whippy trading activity? Okay, pulls price right back to it. And okay, make sense? Let's keep. Oh, very important here. When we look back, notice I believe this is the all-time high in the NASDAQ so far, right? It's up here. Notice this supply zone. This is a very important example of this, right? That we had in our sessions. Notice the location of it. That's my point. Notice the location. It has to be above all of this, not inside all of this, but above all of this. Okay. We don't want to, supply demand zones inside here or inside here don't qualify for us. Structure, location. In fact, notice in here, we have a drop base drop with a gap. A lot of people look at that and say, wow, that's got to be a great supply zone. Price goes right through it. Another one here, drop base drop with a gap. Price goes right through it, right? It's because of location. Those zones in there will not qualify. If some of you are finding that you see the perfect looking supply demand zone and price goes right through it, it's probably because of location. Okay. All right. Mike is asking a great question in the chat. How do you overcome fear when price comes to your level, and have the question whether it will work or not? So two things to that. And they're both big. Number one, when price comes back to a supply or demand zone at any time during an entire trading career, the reality is we never know for sure if it's going to work or not. So, and I know a lot of people, new traders, experienced traders, run into that where, price comes to a level you're thinking, is this going to work? Is it not going to work? The, one of the best things you could do is just be very real and understand that get rid of that question because the answer is clear. You don't know, and you'll never know. There's no guarantee that any trade or investment is going to work, right? So knowing that, as long as we have the risk and the reward planned out, and the risk should never exceed your comfort level, if there's fear there, one thing you can do is ask yourself, okay, if this doesn't work, what's the worst case scenario? What's the worst thing that happens if this doesn't work? If you're okay with the answer, you can take the trade. If you're not okay with the answer, you probably have too much risk on, right? Or you haven't come to terms with the reality of the question that you're asking there. Will this trade work or not? We don't know. Okay. All right. We apply our structure location analysis, um, supply demand zones outside of fair value. We expect them to work. We don't expect the ones inside fair value to work. But the reality is, no matter where or what, you don't know, right? So that's why we have to be okay with the risk. Okay. All right. Let's keep going. So remember, how and why prices move in any market. Again, whether it's the S&P, the euro, crypto, we apply the same rules. I saw your question above there about crypto. We apply the same rules to crypto. We chart crypto. We do all that with crypto. It's the same thing. Or if it's your favorite fruit at the grocery store, like avocados, right? How and why prices. We can chart the price of avocados, and the strategy is not going to change. It's going to be structure and location, right? If we're buying the avocados and selling them to people, we want to buy them at demand or wholesale prices, sell them at supply or retail prices. Okay. We're probably going to end up selling them somewhere inside fair value. Right. Great. I love that comment in the chat. Stacking probability, Malusi. That's a great way of saying it. So some things, I wasn't going to get into this, but you just triggered a thought. So let's say that, for example, here's another one from this is the move this week. So the S&P, this is the high of this week in the S&P. It traded right up into our qualified supply zone. Okay. However, to your kind of comment there, when the S&P was trading up to this qualified supply zone, we had a number of inverse markets down at demand zones. Right? We had some bond markets. I believe the dollar. We had a couple other markets. Okay. So yes, we can stack probabilities, and we want to look at these inverse markets to whatever markets we're looking at, whether it's stocks, bonds, Forex, futures, whatever. Okay. Notice this one again here. Okay. At the time that we were looking at our qualified supply zone, obviously it needs to be above all of this. All right. When you look at this chart, where's the majority of trading activity? Right? Where's the majority of trading activity? Well, most of it is right down here, right? Okay. Those two characteristics are present right here. Okay. And a little bit later, for whatever reason, price trades up to our qualified supply zone. Now, remember the governing dynamic at work. Okay. Competition to sell at supply causes price to turn lower and pushes it lower. Fair value, okay, which is where the majority agree to buy and sell, pulls price back to it. Okay. And kind of the moral of this story is, one of the best filters, at least in my opinion, that you can run through when you're thinking of strategy or strategy rules, if you're whatever strategy you're using, it's probably a good idea to run them through this filter. You know, is the strategy you're using in line with how you make money buying and selling anything in life? If it is, it's probably got some good stuff to it, or probably a decent strategy, right? If it doesn't, probably not a good idea, right? So let's look at another one. Here's also the Dow. This is last week going into this week. What I wanted to point out here, so this was the last time, this is the recent low in the Dow. This is going back 2 or 3 weeks. All of the markets came into major demand zones down here. So what we knew at the time after that happened was the profit zone had been opened up all the way down to here. Eventually, price came back to our qualified supply zone. Now, watch location. This supply zone is above all of this. Make sense? Okay. And again, competition to sell its supply is going to push price lower. Fair value is going to pull price back to it. And then, of course, knowing that the profit zone is open to the downside, there's just a lot of room there, right? Okay. And remember those two characteristics to identify fair value. Um, where's that wide, the majority of trading, right? That recent and relevant, very important. Majority of trading on the chart, and then that wide and whippy trading. And by the way, if you want a more kind of full lesson on that, because that's not the topic we're going over today, I wanted to cover it a little bit for some context to what we're about to get into. But you can always come to any of the workshops we do. I think I'm doing the next one next week, and we spend a lot of time on structure, location, fair value, all that. It's free. You can always come to that. If you need more, if this is enough of these YouTube sessions, then that's great. So now, having spent a few minutes covering how and why prices move in markets, right? How markets work. Now we run into some interesting studies and numbers and research, right? 97% of day traders lost money over a period of 300 days. A study by the Securities and Exchange Commission of Forex traders found that 70% lose money every quarter on average, and traders typically lose 100% of their money within 12 months. Right? That right there should tell you, if you're thinking of trading or trading spot Forex, take your time. Make sure that you understand what you're getting involved in. Make sure that you understand risk. Make sure that you've proven to yourself, before you put risk any of your hard-earned money, that you know what you're doing, and understand that these realities, right? Another study found that nearly 80% had lost money over a 12-month period, and median loss was 36%. These are some realities that everybody needs to be aware of. This should really cause you to focus on following rules, focusing on risk reward, and all that, right? Okay. Yeah. So I see someone in the chat, and thanks for sharing in the chat. By the way, when people share in the chat, it helps everybody. So, right, we're all here to kind of grow together and help each other. And um, right, someone just said lost a lot in gold. Yeah. So there's so many gold. I mean, what I'm about to say about gold is true of just about any market. There's so many opinions out there, right? You have people screaming, buy gold, buy gold, buy gold. And sometimes gold just goes down during that, right? And then you have other people saying sell gold and gold goes up. It's so many opinions, thoughts, strategies, all this talk and information. You know, no one's pushing you to get involved in any of this. So again, make sure that you focus on what's real, not what you feel. Okay. Now we also ask Google, right? What percentage of traders lose money? Google says 90%. I don't know exactly where that number came from, but if the real number is anywhere close to that, that's way too high. So then we thought, okay, if 90% of active traders are losing money, what are they doing? What are the buy and sell decisions they're making? So we asked Google, what are the most popular trading strategies out there? Google says, well, there's part of the list right there, right? So you can see. So a quick little thought is if you want to try to stay out of this 90% of losing traders, maybe be careful doing any of these things right here, right? But why? Why would, if trend following, for example, is probably the most popular strategy out there in the world, um, you know, why 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 are so many people losing money, right? Interested to hear what you think, but it seems like trend trading is probably one of the most uh, popular strategies out there, right? So what's going on here? Well, let's figure it out, right? Why do so many people lose money? Yes, emotional trading is a huge one. Making decisions based on what you feel, not what's real. But let's take a look at this. So I've gone over this in a YouTube session before, but let's revisit this. If it's really all about supply, demand, and fair value, which we also call the novice space, because remember, we don't want to enter positions in fair value, right? Um, think about it. Every store out there that you buy something from, as a consumer, we typically pay the fair value price, right? What if the store that was selling it to us bought that item at fair value? What if they didn't buy it at wholesale prices and instead bought at fair value where they're selling it to us? How would that work out for them? You see my point? Having said that, let's now run through some of the most popular trading strategies in the world. Let's start with the big one, trend trading. Think about it. Trend traders, they don't buy at demand, they let prices turn higher at demand, and then they wait for a series of higher highs and higher lows, and then they buy, right? They don't sell at supply. They let prices turn lower at supply, and then they still wait for a series of lower highs and lower lows, and then they sell. What's the problem? Right? Why isn't this group that's following probably the most popular strategy in the world ultra profitable? Well, they're buying and selling in the middle. Okay. How about people who buy and sell based on news? Right. I want to take you to a quick example of that. Oops, here it is. This is last week. So last week in the equity index markets in the United States, a pretty significant economic report came out. It was, I believe it was CPI. Pretty sure it was, yeah, it was CPI last week or whenever the 10th was, right? Yeah, that was a week ago. All right. And the number was coming out, right at, basically an hour before the New York stock market opened. And anyway, the number, you could see where the market closed the day before. The CPI number came out, the inflation number, and it wasn't good. It was bad. So a lot of sellers came into the market that caused price to gap down right to our qualified demand zone, right? Once the last news-driven seller sold based on that bad news, price was at a level where demand exceeded supply, and the last seller had just sold. Price competition to buy pushes price back up to here. Make sense? That's a pretty big move in a short period of time. But think about it. The buyers and the sellers down here were making one of two decisions. You're making a decision based on what you feel, meaning a bad CPI number just came out, I should sell. Boom, push the sell button. And a lot of people did. That's why prices gapped down so much, right? Or the other person says, the buyer's saying, I'm going to make a decision based on what's real. Yes, the CPI number was bad, but price is down at a level where the chart is suggesting demand exceeds supply. Wholesale prices. We buy at wholesale prices as long as the risk reward is ideal. Make sense? Shubham, yes, the Nifty, absolutely. I mean, when I say absolutely, I mean I know the Nifty very well, and the Nifty does gap a lot because a lot of people make buy and sell decisions, emotionally and based on news and stuff, right? With the Nifty, and but yeah, the strategy we apply the strategy equally to any market, any asset class, and the Nifty is no different. The one thing I would say about the Nifty that's maybe just a touch different from other markets, I mean, every market's just a touch different. How and why prices move never changes. But I've noticed, and I could be wrong, so correct me or forgive me if I'm wrong, but because I've been to India a bunch and I know the Nifty very well, but it seems like people in India tend to make very news-driven decisions, right? It's a very I don't want to say emotional, but when a number or a news report comes out, lots of people act on that. Anyway, but that's why the Nifty gaps so much as well. All right. Mike, good question. So there was a demand zone down here, but price hit this one first. Okay. And that was last week. So back to again, selling when the news is bad. You just saw an example of that. You're typically selling at or near demand or wholesale prices, and that's not going to work. Okay. And a lot of people buy when the news is good. A couple weeks before that, if you bought when Apple announced their good earnings, price was already up a ton, right? And it just doesn't work over the long term. A lot of people use indicators and oscillators. Okay. So notice the pullback to demand here. Where we are an interested buyer. However, a lot of people use moving averages, stochastics, MACD, RSI, all these different indicators. A lot of people use a moving average crossover as a buy signal. Well, the moving average isn't even going to start turning higher until after price does. It's not going to cross until prices move considerably higher. So if you wait for a moving average crossover here to buy, you're not buying till up here, right? Which means you've at least doubled or tripled your risk. All the indicators and oscillators are different versions of the same thing. They all lag price, right? Okay. So if you think about it, adding any tool to your decision-making process that lags price only increases risk and decreases reward. Right? When we look at this, we say a lot of people use this. What's the problem? Why do 90% of traders lose money? Okay. And the last one is just as bad. The chart patterns. If you have a favorite chart pattern, go ahead and put it in the chat. Head and shoulders, tops and bottoms, and triangles, and double tops, double bottoms, cup and handles. They're all, again, different versions of the same thing. They all have the same major flaw, right? If you notice the double bottom here, if we follow the rules of technical analysis, when you have this double bottom, you draw the neckline in, and when price trades above the neckline, you're supposed to buy right here. What's the problem with that? Well, you're buying after a massive rally in price. How do you make money doing that consistently? In this case, you may not even be buying in fair value. You may be buying right into supply most of the time, right? The problem with all of this that you see on the screen here is that obviously you're either buying and selling in fair value, which we see now is not a great idea, right? Again, think of any store that you buy things from. If the store was buying at fair value and selling at fair value, they wouldn't make any money. Right? Okay. But the other thing is, and this is very important, Don't ever, and forgive me for sounding too basic here, but remember, the only way to make money trading, speculating in markets, right, is, when we buy, others have to buy after us at higher prices, or it's very difficult, if not impossible, to profit. When we sell short in a market, others have to sell after us at lower prices, or it's very difficult, if not impossible, to make money in that trade. So the question you need to ask yourself is, when you buy in a market, who's going to buy from you? When you sell short in a market, who's going to sell after you? In other words, whatever strategy you're using, um, you better hope, you better make sure, don't hope, you better make sure that there are other strategies, right, that have people buying after you buy and selling after you sell, right? When the trend trader waits for this big turn to happen and then this big rally and then they buy, who's going to buy from them? Make sense? Okay. So be very careful. Another very real thing to understand is, who is regulating in any country, right? And I can't, I shouldn't say that because I don't know the laws and rules of every country. But for the most part, when it comes to information on the internet, books in the bookstore, what have you, even stuff from a lot of schools, when it comes to trading strategies, all this stuff, trend trading, indicator based trading, everything technical analysis, who is regulating that? Who regulates the content of all these books that are written on technical analysis or trend trading? Or who regulates all that? Who's watching? Who are the police to make sure that that content is effective, is real, is profitable? Who are the regulators watching that? Unfortunately, that stuff is not regulated, right? Or if it is, it's very loosely regulated. Make sense? If if we're able to, um so my point is, be very careful. Very careful. It's very easy for people to make things, look good and look perfect in a book or on the internet or in a video, right? Look, we any of us can go to a search engine on the internet and say, show me profitable trading strategies. You're going to get millions of answers, right? So, and again, we're talking about supply and demand here. Nobody owns supply and demand. It's not like what I'm talking about here is owned by anybody. Supply, demand, fair value, wholesale, retail. Nobody owns that. It's just it's a reality of how markets work. The governing dynamic behind that has been around forever, right? All we're kind of doing here is comparing that to some of these popular strategies, and understanding that, look, the reality is the majority of people lose money. So maybe we should stop or be careful. Just not, don't listen to everything that's said, and don't just take it and run with it. Be very, very careful. Okay. Run it through the filter of how you make money buying and selling anything in life. That's one way to do it. Make sense? Okay. All right. And, at the end of the day, like I said, it's about trading what is real, not what you feel. Okay. Um, Adam, the market maker has some control over the supply, but there's plenty more supply out there in the world, right? Sell orders are coming into the market from everywhere. So, um, yeah. All right. On that note, I didn't want to take up too much time. Actually, took more time than I thought I would. But it's just such an important topic. And, just if you've been trading for a while and losing money, and doing more research of the most popular trading strategies out there, maybe you want to consider taking a step back from that and just think about this stuff for yourself. Don't take my word for it either. Just understand, ask yourself, how do you make money trading or investing in the markets? Right? Buy low, sell high. We all know that that's the answer. Sell high, buy low, or buy low, sell high. Okay. Well, the next question is, where do you buy low and where do you sell high? Okay. Well, to answer that, we need to figure out, where prices are likely to turn in the market and where they're likely to move to. Okay. What creates the turn in price? A significant supply demand imbalance. Okay. What does that picture look like on a price chart? You see what I'm saying? Like you can run through those questions on your own and they're not that difficult to answer. What that picture looks like on a price chart is not simple and easy, right? We spend some time on that, and that's going to take some time. But to get to the answers of strategy, um, anyway, my overall point with that is be careful listening to anyone out there and following everybody. Take a moment and just think for yourself. How does the store that you buy things at, how do they make money? The car dealership, the whatever, right? Um, you know, how you make money, lose money in the financial markets is really no different than how you make and lose money, anywhere in life. Anyway, if you want to take a deeper dive into the strategy, structure, location rules themselves, you can always come to, well, for all of you, because it seems like people here have a lot of experience, it would be the advanced workshop. I don't deliver all of these, but I am delivering these next two here. But and we'll go over. We'll take. We have more time there. Dive into structure, location. On that note, it was great to spend time with you. Great interaction in the chat, and um, we'll see you next time. All right. Have a great rest of your day, everyone.